And so from a business model, we look at things of, how much money are we spending to acquire a customer, and ideally what's the lifetime value of that customer? Because again, real estate is sticky. You're not supposed to be trading this. You're supposed to be in it. We recommend a minimum of 3 years, but ideally 5, 10, 15. You're just building your long-term wealth. It's your long-term savings account. You shouldn't be pulling in and out of it all the time. And that's where compound interest will benefit you. If you look 10 years later, you'll be like, oh my God, how did I have that much money? Right? And that's the goal for the investors.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Sach is the co-founder of real estate investing app Elevate.money. With 15 plus years on Wall Street, Sach and his team started Elevate.money with the aim of making real estate investing accessible for all. Sach, welcome to the show.
Thank you, Sam. I really appreciate it. Happy to be here.
Hey, man, the pleasure's mine. There are 3 questions I ask every guest who comes to the show in 90 seconds or less. Can you tell me, where did you start? Where are you now? And how did you get there?
Absolutely. So I started my adult career on Wall Street. I was living in New York City. I had a part-time job at Credit Suisse, walked into a trading floor, and that was it. I was in love with the attention, the action, the energy. I had to be there. And I figured out a way to get in that field. And I did that for about 17 years. And through life, you grow, you have different experiences, and you want to take those experiences and pass them along and share the knowledge and the wisdom that you gained to help others. And so Wall Street was great for me personally and professionally, but it really didn't satisfy that part of what I wanted to be in life and the story and the legacy I wanted to leave. And that's where Elevate.money comes in. So with Elevate.money, it's a platform that I co-founded with 2 of my partners about 1.5 years ago. And our mission is to democratize real estate investing and give the average investor access to the same wealth building tools that the wealthy have used for generations. That was not previously accessible until some regulations have changed. And now platforms like us are bringing these alternative investments directly to the consumer without a middleman, without a money manager, without high fees, and giving them the same resources that the wealthy have had for a long time.
Yeah, no, that's really cool. I mean, I love the idea from a high level. There's a lot of things I'm sure you've had to think through, and a lot of legal hurdles and a lot of compliance hurdles. I mean, I get dizzy just hypothesizing over what those possibly were. So how did you clear a lot of those obstacles that have just kind of institutionally and structurally been put in place that would prevent an app like yours from ever coming to market?
Yeah, it's a great question. There's 2 answers to it. One is my co-founder, Harold Hofer, is actually a pioneer in real estate crowdfunding. This is the second company he's launched in the space. So he's dealt with a lot of those problems for a long time before and has found solutions. So we had a little bit of a head start there where, he knew the playing field. He knew, who we needed to talk to, what we needed to get done, and how to get it done to get the platform up and running, to get past all the regulation and bring it to market, knowing what we can say, what we cannot say, all these things I think are important to understand because there is a lot more regulation when you're dealing with Reg A, which is the other way we could do it is, through the Jobs Act, there was an opportunity for companies to start raising capital for investments from the average investor. They didn't need to be accredited. They didn't need to have $1 million or make $250,000 a year. They could be, an average person, but they're more regulated. The SEC regulates those companies way more. So we're one of those companies. And so just understanding those hoops and knowing what needed to be done. So we had a little advantage there.
Gotcha. Yeah, I mean that's it. You have to have a team member and or be the person that understands how to navigate those waters. Because again, you threw me in that arena and be like, I give up. This is going to be chaos. So that's really, really cool that you guys figured that out. So walk us through how the platform works. How do you guys onboard properties? How do you guys onboard, investors? Just give us the lay of the land.
Sure. So we try to simplify it as much as possible. And the thought process is, we've seen other platforms do this, bringing real estate investment, to the average investor. And one of the things we realize is that when you're investing $100, $500, $1,000 versus, $25,000 or $100,000, the level of due diligence, the level of time and understanding you have in that process may be less, and also the energy you want to put into is a little less. And so we want to make sure things were simple enough to understand and also do all the heavy lifting for the investor. So instead of saying, hey, here's 10 properties, pick the one you like the best, and they don't have the resources to go do the underwriting or due diligence on 10 properties around the country, with us, they're investing in a portfolio. So we use a REIT structure. And with that REIT structure, what that allows us to do is to continue to accumulate investors, add more properties into that portfolio, and then every investor gets a fractional ownership of the entire portfolio. So the more investors we get, the more properties we buy, the more diversification within that portfolio there is for all investors. So that's the simple structure. And then from the platform perspective, it's really simple. I mean, it takes about 5 minutes to become a real estate investor at Elevate.money. And basically, you start the onboarding process, create a profile, a few questions for the regulatory bodies, and then in essence, you're doing a ID verification, choosing the investment amount, connecting your bank. We do an ACH to your bank, collect the money, you get approved, and you're a real estate investor. And that's as simple as it is. We take that money, we find, buy, and manage properties, we collect the rent, we take out the fees, and we then pay dividends on a monthly basis. So to date, we've paid a consecutive dividend payment since we've launched the platform with an annualized yield of about 6.5%.
That is great. I love that. I mean, so you guys are the ones personally acquiring the assets.
That's right. That's a great point because you will see a lot of platforms out there who are choosing to really be a middleman where they're the kind of the marketing agency and they're going out and saying, hey, invest in real estate, come on our platform, and you'll see all these different investments on the platform. But the people making the investments, you don't know much about them, and they could be 50 different people, 100 different people. And so it's really just a marketplace connecting, buyers and sellers in essence. What we're doing is we're taking that risk off the table and we're saying, the buck stops with us. So tomorrow, when COVID happened, if you had a portfolio and you bought 4 or 5 properties and 1 or 2 weren't getting yield and you called up one of these platforms, well, they'd have to either call all of these different counterparties or hand you off to them. And you're like, well, I didn't work with them. I worked with you. With Elevate, there's no one else. So we're doing the in-house management. We have a CIO who, has bought about, over $500 million worth of real estate in the space with our co-founder at their previous company. So we have a team in place that does all the work and manages all of this stuff. And that team will continue to grow as we grow.
It's kind of a chicken and egg question because you need to have teams in place who are acquiring assets. And then you're building out this platform side of things, which is really the marketing arm. Just like a lot of us as syndicators, it's the marketing arm. It just on with a very different focus and a very different way of acquiring capital. But I guess how did you guys finally form this into where you said, "Hey, this is a viable idea, and we've actually got something that we can then grow"?
So we did a survey. We thought to ourselves. I mean, Harold's idea when he came to myself and Alex was, listen, I did this before and we raised, $400,000 of assets under management in my previous, online crowdfunded platform. But we targeted a different audience. And I believe that now with Acorns, with Robinhood, with all of these Betterment, Wealthfront, all these platforms, this younger audience is looking to invest online, and there is no real estate solution targeting them, speaking to them, offering this product to them. And I believe that could be the future because, again, this is an audience that is going to grow. These investors are getting older. They're going to earn more money. They're getting in the workforce. They're, millennials and younger even, I should say, while baby boomers, let's say, who may control a lot of the wealth in the country today, they're going to be dying off and getting out of the workforce. So we're betting on a smaller investment size, a smaller capital, outlay today with a younger investor, but one that's going to continue to grow with us and be the predominant investment group in 10 years, where it's predicted that millennials will overtake baby boomers in wealth in the country by 2030. So that's the bet that we've made from an audience perspective. And so we did a survey before we launched the platform. And, the results basically said that these younger investors wanted to invest in real estate, just didn't know what to do, where to go, what to buy, how to do it, or didn't have the capital to do it. So those are all the things that we solved. And we put a deck together. We got some investors. We raised a seed round. We bought our first property. We, got our product regulated and set up by the SEC, licensed and done all of that stuff. Built out the website, and started to run traffic. And we've been getting customers, and they've been investing. And one really interesting fact that I'll share is that, which we were surprised too. We didn't know the number would be this high this early, but 40% of our sales of shares per month come from existing customers, even though we've only been around, for about 8 months to the public. And what's interesting about that is about 28% of that 40% comes from auto invest. So because these are smaller increment investors, somebody might say, hey, let me invest $500, $1,000, but then I'll also put 100 or 250 every month and then build that over time. And then over the course of several years, I put in several $1,000s, and then I'm reinvesting all of those dividends. So now that's constantly compounding. And that's where the power of the investment comes in. It's not like crypto or, a tech stock that could go up 10, 20, 40, 100% up today. Probably also won't go down that today. But over time, the compound interest will benefit an investor. And that's what we're trying to educate this investor group. Say, hey, listen, you don't have to don't put all your money in this at all, but definitely you should have some portion of your portfolio, build a balanced portfolio, should have high income producing hard assets, and this is the easy way to do it and get the benefits.
That's really cool. A lot of times you hear investors or syndicators say, hey, you know what, we're raising our minimums. It used to be 50 grand. Now it's 100. And then I hear some guys and gals saying, well, it was 100. Now it's 200. Like that's their minimum investment, because the smaller the investor, the smaller the investment amount, typically the greater the amount of work per that investor. Because if somebody gives me $5 grand, that's all they can afford to invest in a deal. One, they probably shouldn't be investing in my deal. And secondly, they're going to be very worried about that $5 grand. How do you guys address that without just creating enormous amounts of communication and work on your side of the table?
Well, I think that's the beauty of sort of digitizing the platform. Most of the young audience is used to not really talking to people all the time. It's used to getting all the information online, wants 24/7 access, wants to be able to look at it, wants it to be visual, wants knowledge, education, all of those things. And if you satisfy them with that, and you have a good investment, a good product that they're earning interest and growing their wealth, they're going to stick with you, and they're going to add more to it over time. And so that's how we're addressing it. And then from the investment perspective, it's not like we say you can only invest $500. I mean, you can invest hundreds of thousands of dollars in the platform. And we have investors that put as little as $100 to start, to test it out and see what it's like. And we also have people who put 20,000 and 50,000 and 100,000. So, it all kind of averages out. And so from a business model, we look at things of, how much money are we spending to acquire a customer? And ideally, what's the lifetime value of that customer? Because again, real estate is sticky. You're not supposed to be trading this. You're supposed to be in it. We recommend a minimum of 3 years, but ideally 5, 10, 15 years, building your long-term wealth. It's your long-term savings account. You shouldn't be pulling in and out of it all the time. And that's where compound interest will benefit you. If you look 10 years later, you'll be like, oh my God, how did I have that much money? Right. And that's the goal for the investor. So because it's sticky, even if they're smaller increments, and people on average will hold the investment and add to the investment over a long period of time, we can be profitable, on a lifetime value for that customer.
Yeah. Talk to me about the liquidity of this. Obviously, when you're buying shares in a syndication,
Yep.
It's an illiquid investment. Is that the same true on your side?
Same true. So what we do is we give, I don't know if it's exactly 2 or 3 months, I'd have to check, but the first short period of time, 2 or 3 months, they can actually change their mind and pull their money out without any penalty. And again, we realize like a lot of our investors are new, they're younger, they might, want to dabble in this. They want to see if it works. They want to see if we pay an interest payment. They want to see if it's real. So we give them the freedom to say, hey, come in. And if you change your mind within the first 2 or 3 months, no harm, no foul, send your money back, all good. After that, it goes into, I believe it's a 2-year lock. Maybe it's a 3-year lock. I always forget the 2 and the 3. But then it goes into a certain lock period where now you're holding the investment for a period of time to earn, your income and let the portfolio be stable. You can always take it out with a small penalty. So you probably give up some of your interest to do that. But generally, that's the goal, is that, we get people in, if they're comfortable with it, they're in it for at least 2 or 3 years, and ideally by then we've proved to them that we're helping them accomplish their goals, and they're now making more money because they've grown and all those other things. And instead of taking money out, they're actually adding more money in. And that would be the kind of business goal.
Got it. I love it. What are you guys seeing for opportunity on the acquisition side? Because you guys are running a full-time real estate acquisition and investment company. Where's the opportunity lie for you now?
Yeah, so we do a whole lot of due diligence, and again, when you're a platform like ours, we made the bet. We had the view and the strategy that we don't want to take on a lot of risk. We rather, so if you're an investor and you're saying, hey, I just saw a real estate deal with 18% yield, 22% yield. That's not who we are, because we're not doing development deals. We're not doing fix and flips. So we're not taking that level of risk. And the main reason is our goal is to build a very big platform. And so we don't want to have a hiccup along the way where we hurt investors, because things can happen, things can go wrong, especially in the beginning when you don't have the history and you're small, and we start taking outsized risk for people, something doesn't pan out, then it's over. Then it's like, well, that didn't work. We didn't make money with them. They're not good at what they do. So our view is to be more conservative. So we build a portfolio, and we're also looking at income producing. So we're not really betting all our chips on the capital appreciation. We want income producing day one. So we're buying properties that have existing tenants. We're looking for leases, minimum of 5 years. Ideally, the portfolio has a lease of 10 years on average. High quality tenants. And, we do due diligence on the tenant, on the location, on the business, on the property, all of these things to make sure that, this is a good asset that can sustain, economic cycles, that can sustain, different things that can happen. And we have a high quality tenant, they can pay their rent. That's the goal. And then we leverage no more than 60%. So we're minimum leverage from a real estate perspective, that, tomorrow things do take a downshift. We're not all levered in and kind of squeezed there. We've got a lot of equity in the deal from the beginning. And so with that, we're able to earn our income, take our fees, do all the management, run all the expenses, and pay out about a 6.5% cash on cash yield for the investor. And then ideally over the course of a year, through asset appreciation, tax benefits, all of that stuff that flow through, the gross yield could end up being, maybe 9% or 10% for the investor.
Got it. That makes a heck of a lot of sense. Certainly appreciate that. Let's talk about one last kind of logistical question: accounting. I mean, accounting on the back end of this, just like, again, it goes back to the legal and accounting are the two hurdles I see in this, in my own kind of analysis. How have you overcome and settled that? Because you have investors coming in and out all the time. It just seems like there'd be a lot of movement there.
Yeah, there is. And we have someone on our team that kind of does a lot of the analytics and also just manages that process. But we also have a third party kind of fund manager that we work with and outsource that work. Now, that's an interesting question, because that's how it's done today. And I actually believe that the future of that is something that, I think people talk about, but they look at it from a different perspective. That's where blockchain and tokenization and things like that will come in from a utility perspective, not really to create liquidity in real estate where people are trying to trade a commercial property every day, which is not really the purpose of the asset, but really on the back end of all of the questions that all these things that you're bringing up, there's a lot of nuance, there's a lot of labor, there's a lot of time. So time and money, which generally, the investor is paying for, right? And so as we evolve, and we're already starting to kind of think about this stuff. So, hopefully we'll be an early adopter of it's when it's ready. I don't think it's ready today, but it could be a year from now, it could be 2 years from now. I do think that process will be in a smart contract. And so you'll be buying a token that represents the portfolio. And then that smart contract is constantly calculating how many shares are outstanding, what's the net income, what's the, who gets what, and the transfer happens immediately back into your wallet, if you will, versus, the fund, we close the books and now we send the information to the fund manager is calculating all this stuff. 4 days later, they come back and tell you, then you got to ACH the money for 3 days back to the investor. You lost, 10 days and you're paying people for that. So I think that's going to benefit investors from a time and yield perspective, because they'll get that money that's not getting spent.
Right. I love it. I love the forward thinking there. I love the problem you guys have solved so far in the marketplace. I mean, a lot of moving pieces, and you found a solution to a lot of it. So I think that's really, really cool. Sach, thanks for taking the time to come on the show today. If our listeners want to get in touch with you, learn more about you and or your app, what is the best way to do that?
Best way to do that is check out our website, Elevate.money, or find us in the iOS App Store. Android app will be launching soon. And we have a support desk with emails, all that stuff on the website. And someone on our team is always there to answer questions and connect with our audience.
Awesome. We'll make sure we get that also in the show notes there, Elevate.money. Sach, thank you again for coming on. I certainly appreciate it.
Likewise, Sam. You have a wonderful day.